All right. I ditched the headphones. I got a real microphone. I got a real camera. Hopefully, this works better. Got some lighting. We'll see how this goes. So, I had a soldier that sent me a Teams message today, asked me about a cash out refinance versus a home equity line or home equity loan, what the difference is, which one should they take. And I know if you got one of those VA loans, they are sending you stuff all day long. 3, 4 day. Hey, cash out refinance. Hey, access your equity. So what's the deal? What are they gonna do? So I looked. I didn't feel like making a bunch of graphics for this. I got this nice, soothing background here, but let me pull this in. This was kind of well done, but I'm gonna critique it a little bit. Cash out refinance versus equity loan. This is by bankrate.com. They're sort of independent. Sometimes I'll recommend some companies, but they're mostly independent. Here is a little bit of the difference between the two, but this is kind of uh, bland. It doesn't tell you everything. So first, cash out refinance is you're taking your original mortgage, redoing it, adding some cash out to it. So let's say you owe 150,000 and you have equity of you want to take 30 additional thousand out. Okay, so they're going to take your 150 that you owe and they're going to take the 30 that you want, put those together. Now your mortgage is 180,000. Comes with closing costs on the 180, on the full 180. This is your first mortgage now. So that essentially took your first mortgage to 150 to 180, and that's all going to be lumped in together. So that's going to, if you took a 30-year mortgage, that's 180 for 30 years. If you took a 15, 180 for 15. If you took any kind of adjustable rates, it's all going to be on that 180. Okay, and if you got like a 3% mortgage or something back a few years back, you're probably not going to want to refinance that because you're going to be looking at 6 at least in this time frame. Um, so not a lot of people are looking at that again. And also, if you are, now we could do the math on this, but you are within 6 years of your original mortgage, you're still paying a majority of interest, and you have probably haven't touched the principal a lot. So you're just gonna, that's all gonna reset. Now instead of doing mostly interest on 150,000, now you're doing mostly interest on 180,000. Um, on the cash out refinance, I think this is a little off. If you're on a VA loan or if you're on a FHA or something specialty loan, low down payment, they're gonna get you closer to what to your closer to your 100% value. So let's say, for instance, you want the 180 and you're at 200,000 appraisal. You could probably pull that off on a cash out refinance because you're about, what is that, 85% uh, left on your home equity. So they'll probably do that. A home equity loan, on the other hand, is a totally separate loan. Okay, the cash out refinance is done by a mortgage company. A lot of banks have a separate mortgage company. Um, all the paperwork, stacks and stacks of paperwork. The home equity loan is just, that's exactly what it is. You just take the small portion of equity that you want and get a loan on that. You're not touching the original mortgage. Okay, the original mortgage is what's called first lien position. They get their money first if you were to get foreclosed on. Home equity loan is in a second lien position, meaning they get their money second if something may happen. Interest rate, that's going to affect the interest rate a little bit. It may be a little higher depending on um, how much equity you have in your house. They're also going to be a little more strict on your equity. So they're going to cap it hard at about 20%. You They want that 20% cushion just in case you get over leverage. So, for instance, you could only take 80% of what your house is worth total. between the two liens, between your mortgage and your home equity loan. So it's going to be a little more strict on the home equity loan, but you could structure that however you want. It's not lumped into the first one. So you can do 5 years, you can do interest only, um, and with the balloon payment, I mean, they structure these a lot of different ways. You could have a 10-year. Um, Back prior to 2008, they came back a little bit and then they totally disappeared in 2020. You had what's called a HELOC, home equity line of credit. It was like a credit card that was linked to your home equity. So they'd say you have a line of 30,000, use it however you want. Okay, you use a little bit of it, pay it back. Use a little bit of it, pay it back. You could still find those. I looked the other day. You can still find those. They're not going to be with your Wells Fargo's, your Chases, your Bank of Americas. They're going to be with a little more sketchy lenders, and that's because as soon as the housing market starts to move in a bad direction, they're going to call those HELOCs in real quick. You're going to get a call and say you owe us 30 grand. We're closing everything down. We'd like our 30 grand, please. Happened a lot in 2008, a little bit in 2020, but yeah, they're very different in terms of how they're used, how they're structured. And a home equity loan, you don't necessarily need to do that with a mortgage company. When I was a manager of a bank, my I could do it as a manager, or my personal banker could do it right there, sitting right there in the bank office. Pretty easy to do. The calculation's pretty easy. Hey, we'll lend you 80% of what your house is worth, minus the 150 you already owe. We could get you 25,000 of that 30,000 that you need. Unfortunately, if we go the full 30,000, that'll hit the cap, and you won't be able to get that last five. If you want to do a cash out refinance, you can go that route. Again, that's a whole new mortgage. Usually, when I look at situations, I'm like, oh, you're gonna do a huge pool barn that's gonna cost $100,000. Yeah, why not put it on a mortgage? Get it, get the, put it all together. It's gonna help with the value of the house. You can, it's gonna appraise better. But if you're just using it to pay off bills, you do not want to finance your bills for 30 years. So that's a little bit on the difference. Read some articles, look it up, call your local banks. They'll have preferences as well. Sometimes they'll have deals on the home equity loans. Um, if you use all of it right away, then sometimes they'll give you a deal on the interest rate. If you have a direct deposit or a direct debit to pay the bill, sometimes they'll give you a break on the half percent or something, break on the interest rate. So they run deals on this all the time because they are a bank, and these do close pretty quick. The home equity loans, they can run deals on. The cash out refinances is going to go by the mortgage rules, whole FHA, whole VA, whole traditional mortgage routes. So that's a little bit on the two. I thought it was an interesting question. I thought I'd explain a little bit of that. And all right, till next time.